Hello, my name is Kokila. Before we start with our lectures, I'd like to clear some things off first. So, the paper that we're going to look at, F7, is built on F3, and I realize that most of us have an exemption for this paper, so I'm going to try to make this as basic as possible. But I do need you to know the basics that we learned in 11th and 12th, such as journal entries, ledger accounts, and the basic format of your financial statement. Next, these videos are just a guidance, they do not substitute for classroom learning, which means that after this you will have to go through your study text and practice and revision kit, and you will need to revise like thrice. You will have to cry yourself to sleep every day, sell your soul to the devil. So all the best for that. Next, I use BPP as a learning provider. We have 3 learning providers, which is BPP, Kaplan and Becker. Please choose one and stick to that, and see to it that you get both the practice and revision kit and the study text, because the practice and revision kit is very, very, very important. Next, any doubts, you can comment it in the comment section below, or you can DM your doubts to this account on Instagram. This is your syllabus. Section A talks about the conceptual framework and why we need standards, what are the standards. Section B are the standards. Section C talks about ratio analysis and interpretation of financial statements. Section D is preparation of financial statements for a single entity and consolidated. We will be following the syllabus in this order, because only when you know section B can you go to section C and D. So this is just an outline for the portions of section A. It talks about the qualitative characteristics of usual financial information, and I think most of this is just logic. If you go through this, you can understand. It talks about how the information should be verifiable, it should be timely. For example, if your boss asks you for a statement, let's say within 2 days, and you give it to him in a month, first of all, you're fired, and second of all, what is he going to do with that after a month? So all of this is just general logic. And it talks about how going concern is an underlying accounting assumption. Going concern means that your business will continue for the foreseeable future. So it's not going to end in another 10 months or 11 months. It's not a relationship. So you're optimistic and you're saying, my business will continue for the foreseeable future for an indefinite period of time. Next, let's move on to the elements of the financial statement. Your financial statement is divided into your statement of financial position, which is your balance sheet, and your statement of profit and loss. Now, the SOFP has your assets, your liabilities, and your equity. An asset, by definition, is a present economic resource controlled by the entity as a result of past events and has the potential to produce economic benefits. Now, the definition might seem complex, but then it's relatively simple. Let's take the example of a piece of machinery. It is a present economic resource, which means that machinery is with you right now. It is controlled by the entity, which means that you get to decide what to do with that machinery. You get to decide how much it produces, what it produces, and you get to decide if you just want to cripple it down with a hammer. It is a result of past events, the past event being that you bought that machinery, and it has the potential to produce economic benefit. Here, the economic benefit, if you are using that machinery to produce your stocks, would be that you sell your stock to make a profit. So that will be your economic benefit. So economic benefit can be in terms of cash, it can be in terms of goods, or it can be in terms of a reduction in a liability. Now let's come to the liabilities. A liability is a present obligation to transfer economic resource as a result of a past event. So let's take the example of a creditor. You have a present obligation to pay your creditor. Transfer of economic resource is in cash. You have to pay them in cash as a result of a past event. You would have gotten supplies from your creditor, let's say 2 months ago. So that would be your past event. So what are the standards? The standards are a set of rules that you will need to follow in order for you to properly construct a financial statement. Different countries had different standards, and because of this, it made comparison very hard. It made it hard for investors to properly analyze a statement which comes from a different country. So what the IASB did is that they came up with a standard called the IFRS, which is now being implemented by every single country so that there is harmony in the standards and there is global congruence. So that's all for this video. Thank you so much for listening. If you have any comments or you think that it can be made better, constructive criticism is always appreciated. And in the next video, we will start with our standards.